red flags aren't about illegal deductions. They're about excessive, inconsistent, or poorly documented deductions. And when something looks statistically abnormal, that's when scrutiny increases. Most red flags happen when deductions are decided at year end, documentation is created after the fact, ratios aren't reviewed mid-year, owners don't benchmark their numbers. Hello there, Salim Omar here from Straight Talk CPAs. I am joined today by Sabir, our Senior Tax Advisor. Sabir, welcome. Today we're going to talk about a topic that a lot of business owners think about, which is business tax deductions, but really they're worried about the things that trigger an IRS audit, and that's what they want to avoid, because that can be a big nightmare, is having an IRS audit. So that's the topic for this video. Looking forward to it.
Yes. So this is also, one of the major discussion going on. But I totally agree with you. Being the taking more deductions and getting red flags. So every business owner wants to lower their tax bill. That's smart, right? But there's a line between maximizing the deduction and creating unnecessary IRS attention. So it's like the IRS doesn't audit just because you took a deduction. They audit when numbers look unusual compared to business in the particular industry, or when it's compared to other financial situations.
And this is important because, red flags aren't about illegal deductions. They're about excessive, inconsistent, or poorly documented deductions. The IRS uses data analytics. They compare your expense ratios to others in similar income brackets and industries. And when something looks statistically abnormal, that's when scrutiny increases.
Yeah, totally agree there. So, if we take an example of the type of deductions that raises these kind of red flags, so the first thing comes to my mind is excessive meals and travels, right? Because meals and travels are completely legitimate business expense, but they become risky when they look inflated relative to the revenue. So for example, if a business earns $90,000 and report 30,000 in meals and travels, so that ratio doesn't align with most industries unless there is a clear explanation, right? So the IRS expects documentation, like who you met, what was the business purpose, what was the location, proof of your payments to the restaurants, and things like that. So definitely it needs a lot of thinking and documentation to prove these kind of expenses.
So the IRS knows business owners often mix personal dining with business meetings, right? That's why this category gets attention. And clean records and reasonable percentages can make all the difference.
Yes. So these red flags arises where there is a potential of an expense being categorized as a personal and as well as business. So the another expense comes to mind is a vehicle expense. Now, vehicle deductions are one of the most audited areas in a small business that claims 100% business use of vehicle, because that is also your personal car, and it's extremely difficult to defend without a proper time log, without a proper mileage log for that particular vehicle, right? So if you are writing off a fuel, insurance expense, like a maintenance, depreciation, or using the standard mileage method, the IRS expects a detailed records, like not estimates that were created at the end of the year. So if there is a high mileage relative to revenue, or there is a multiple vehicle under a one business or a single owner, so these kind of raises a concerns when you do not have a detailed mileage log maintained for the vehicle.
Yeah, this is where business owners unintentionally create exposure. They assume that because they use the car mostly for business, they can claim all of it, like 100%. The IRS requires precision. not assumptions and not generalities that it's 100%, because that's not going to be believable.
Yeah, I mean, so as we keep on discussing these things, there are a lot of expenses that comes to my mind, right? So I would say like another one is the home office deduction. So the home office deduction is a legitimate but often exaggerated due to the square footage of the use. So that raises a red flag, right? So the first and the most important thing is the space must be used regularly and exclusively for business. Now, now if you live in a modest home and claim half of it as an office space, so that invites an scrutiny. So and also additionally the deduction must align with your type of business, right? So if you claim a large home office but your work rarely requires administrative task at home, so it looks inconsistent. So this is another reason that raises the red flag for the IRS.
The key issue here is reasonableness. Reasonableness. Measurements should be accurate. Percentages should make sense. Documentation should exist. When all these pieces are in place, then the deduction is defensible.
Yes, definitely. So let's say a taxpayer has everything which you just mentioned, like reasonableness, measurement, and documentation, right? So another important thing is, what if they have accumulated all the expenses under a single line, other expenses in the tax return, right? So there is another a common red flag. So because very often when these expenses are accumulated under a single line item, it appears as a large number on the tax return. There is a separate line item, other expenses, so under that. So when thousands or tens of thousands of dollars are grouped into a single category, now it signals a lack of transparency, right? Even though you have everything, documentation, everything, even though those expenses are legitimate, now it signals lack of transparency, not a personal versus business, those kind of things, right? So the IRS prefers clear classification like advertising, supplies, insurance, professional fees, etc. So I would say like a bloated other line item makes it easier for an examiner to question what's inside, and like what is the important thing that can prevent these kind of situations. So would you like to go ahead, Salim, mentioning, I would say most important thing is a bookkeeping in these kind of situations?
Yeah, I mean, in my 30-year career, clean bookkeeping is one of the most underrated audit defenses. Detailed categorization shows intent to comply.
Yes. So once you have a clear bookkeeping and a clear documentations and a detailed mileage log, detailed log mentioning the square footage of your home, right? Once you have everything, now there are other aspects as well. Let's say now that business is generating loss for you because you have all these kind of expenses, right? So if this generates a business loss year after year, I would say especially more than 3 out of 5 consecutive years, now there is another red flag, because IRS may question whether the activity is truly a business or a hobby, right? Because if there is a loss for 3 consecutive years, a question comes to mind like why a business owner is still getting carried on with this business. Is this his real business or just a hobby, right? Because if there is no profit motive, if you are not investing any time, right, so then it is, and there is a chance of categorizing this as a hobby. Now once it is categorized as an hobby, your deductions are limited, so it cannot generate a loss, and you cannot use those losses to offset wages, interest, and other things. So I would say repeated business loss can be another IRS red flag.
And interestingly enough, once something is classified as a hobby, then the deductions become severely limited. Yeah, that's why strategic planning is really, really critical when losses occur.
Now, another area where there is a significant audit risk is S corporation and paying extremely low salary to the owner, right? So for
Mm,
S corp owners, one of the most significant red flags I would say is unreasonably low compensation. So if the business generates substantial profit and the owner pays themselves a minimum, like a very nominal salary, but they are taking a large distribution, right? So that
mm,
attracts attention. Now, why? A question comes to mind that why it raises an audit flag, because they are taking out their own money, right? But IRS has specifically mentioned that they need to take a reasonable salary. Reasonableness is not defined. That's why these area has a significant chances of like getting IRS audit. So I would say it's about balancing them properly within the compliance, that how much to take as a reasonable salary and how much to take as a distribution.
yeah, and it favors the owner, the taxpayer, when they take the lower salary. The lower the salary, the lesser the tax. So the IRS has got rules, requirements of what the owner needs to take, and they term it as reasonable compensation. What you shared there, this is one of the most frequently adjusted items when an IRS audit, an S corp audit takes place. So it's not about avoiding payroll taxes. It's about really balancing them
Yes.
properly with compliance.
Yes. So, like, you can say there are kind of mixed uses element to these distribution versus wages as well, right? But again, the other important thing that comes to mind are other nominal expenses, right? So individually those expenses seem small, but when we combine it, it seems a significant amount, like expenses like cell phones, internet, and certain subscriptions often have both personal and business use. So if anybody is claiming 100% business use without having a clear evidence, it can also look aggressive approach. So generally the IRS evaluates proportionality. If the expense naturally includes personal benefit, right? So claiming it fully as a business without justification increases risk. And under this category, I would say most of the expenses what we discussed previously falls under this category, like traveling, meals, home office deduction, right? So yeah, I mean, if there is an element of a personal benefit, so claiming it 100% without justification definitely increases the IRS audit risk.
Yeah. Reasonable allocation reduces is exposure. Precision builds credibility. Any other, if you can kind of give us a quick high level as we are wrapping up this session here, any other high risk tax deductions that come to mind? Perhaps give us a few more.
Yeah. So I would say, like, always to bear in mind that if that particular expense can have both business and personal element, that's a big red flag without a proper substantiation. Now,
Mm,
another expenses or another category would be contractor versus employee misclassification. Now, this is not a
mm,
deduction issue. This is, I would say, a classification issue, right? That's a major red flag category, because you need to pay payroll taxes on an employee, but you are not required to pay payroll taxes on contractor. So if you misclassify this category, then you will have a liability of filing payroll tax return every quarter. So that's another, I would say, a big red flag. Now another red flag is excessive startup cost. Like, so generally whatever they are incurring for their business, it is a startup cost. So they cannot take 100% deduction in the first year. It needs to be amortized over a period of 180 months, right? So if you take 100% deduction of startup cost, that again raises a red flag. Now the other one is large charitable contribution relative to your income. So especially when contributions are unusually high compared to revenue,
mm,
like a donor advised fund used aggressively, or your documentation is incomplete, because with some special kind of contributions they need appraisals and a fair market value certificates. So if you do not have this, then your documentation is incomplete. So this is another reason of a red flag. Now, very basic criteria for raising red flag is like always rounding numbers everywhere, right? So $5,000 for meal, $10,000 for travels. So perfect round numbers year after year can look fabricated, because there are a lot of taxes that when it's added to your invoices, it does not generally round off your numbers. So yeah, I mean, that is
Correct.
another one. And I would say like excessiveness, whether it's relating to your consulting fees, management fees, Augusta rule. So excessiveness is also a major criteria, like payment to related parties. Always, these expenses are always inflated. Payment to family members or creating out of state entities. This can definitely raise a scrutiny, I would say, from the IRS.
Yeah, yeah. You know what these red flags have in common? I mean, none of these are illegal. The most common pattern is lack of a planning rhythm. You know, most red flags happen when deductions are decided at year end, documentation is created after the fact, ratios aren't reviewed mid year, owners don't benchmark their numbers.
Yes. So, I mean, let's say how to avoid and minimize the IRS scrutiny chances and maximizing the deduction. So, what is the measurement to do all of these things, right? So, I would say there is no one rule for avoiding all these situation. It generally requires tax planning. I would say at least twice a year. You also need to review expense ratios regularly. You need to review salary levels, like reasonable wages versus distributions, and you also need to see the documentations. So when you look at all these things and take care of these measurements, so red flags, I would say, almost disappear. Obviously it doesn't like disappear entirely, but I would say it almost disappears by taking these kind of measurements. To close, I would say none of these expenses are illegal, right? They are all legitimate business expense, but they are legitimate only when they are reasonable, properly documented, and proportionately justified when it is compared to business industry and your business activity. So what triggers red flag is exaggeration, inconsistent reporting, I would say, or a vague record keeping and a numbers that falls far outside the industry norms.
I want to end with something that I've seen a lot with business owners. Smart tax planning isn't about being conservative out of fear. It's about being strategic. It's about being accurate and defensible. The goal isn't to avoid deductions. The goal is to take every deduction you're entitled to and be able to support it if ever questioned.
If you found this video helpful, don't forget to like, share, and subscribe. For personalized tax strategies and expert guidance, scan the QR codes on your screen to visit our website or book a complimentary consultation with our team. Thanks for watching.